Welcome to the Q1 FY24 earnings conference call of Patel Engineering Limited, hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gopal Chandar from Kirin Advisors. Thank you, and over to you, sir.
Thank you. On behalf of Kirin Advisors, I welcome you all to Patel Engineering Limited Q1 FY24 Concall. From the management side, we have Ms. Kavita Shirvaikar, Whole-Time Director and Chief Financial Officer, Mr. Rahul Agrawal, Head Strategic Finance, Mr. Aditya Bajaj, Investor Relations. Now I hand over call to Ms. Kavita Shirvaikar. Over to you, ma'am.
Thank you. Good evening, ladies and gentlemen. A very warm welcome to all of you, and thank you for attending this earnings call for Q1 FY24 of Patel Engineering Limited. The presentation summarizing the performance of Q1 FY24 and the press release along with the result has been uploaded on the stock exchange, and I hope you all have had a chance to look at the numbers. As usual, instead of going through the entire presentation, I shall be giving you all a short brief of key highlights of the performance of the company in this quarter, and then we will be happy to answer any questions which you all may have. Now coming to the overall global economy has been showing signs of recovery, although coupled with persistent inflation and intermittent financial chaos. The April 2023 World Economic Outlook update anticipates a moderation in global growth to 2.8% in 2023 from 3.4% in 2022, followed by a rise of 3% expected in 2024. However, this forecast indicates a notable rebound from the challenges faced during the pandemic. Despite the global uncertainty and volatility, India is witnessing its economic activity gaining momentum. The GDP growth in the fourth quarter has pushed up the full year GDP growth of FY2022-23 to 7.2%. Infrastructure is a vital enabler in India's journey towards becoming a $5 trillion economy, $5 trillion US dollar economy. The government's strategic focus on infrastructure spending is expected to not only stimulate economic activity but also foster innovation, ultimately building a society that is more resilient and connected, ready to tackle future challenges. India is committed to achieve net zero emission by 2070, and by 2030, India plans to achieve half of its energy generation requirement from renewables. The government has set an ambitious target of establishing a renewable energy capacity of 523 gigawatts by 2030, which currently stands at 417 gigawatts. Including a substantial 73 gigawatts from hydro sources. Currently installed capacity of hydropower in India is at 46 gigawatts, so around 27 gigawatts of hydropower is expected to be added in the next 7 years. According to CEA, the incremental outlay for evacuation of the renewable power is INR 2,44,000 crore in next few years. Of this, the addressable opportunity for EPC players is likely to be INR 1,50,000 crore. Hence, the growth outlook for EPC company is strong with continued growth in infrastructure spend, especially in the renewable energy segment. A major pie of our order book comprises of hydropower projects, and today hydropower remains a crucial player in the renewable energy sector, providing nearly half of the world's low-carbon electricity. India currently has the fifth largest hydropower production capacity in the world, with a large availability of water bodies. India has enormous potential for hydropower generation. Hence, we will see a lot of work coming up in the hydropower sector in the coming few years. And since our majority order book comes from this segment, we are likely to get quite a few orders from this sector. Also, the Indian government acknowledges the vital role of irrigation projects, especially micro irrigation projects. With agriculture being a key component of the economy, investing in irrigation has become crucial to address challenges like water scarcity and irregular rainfall patterns. The government is actively promoting irrigation initiatives to mitigate extreme weather effects, enhance crop yields, and reduce farmers' vulnerability to drought and floods. Initiatives like Pradhan Mantri Krishi Sinchay Yojana for 2021 to 26, there has been an outlay allocation of around 93,000 crore, which would benefit about 22 lakh farmers. This is one sector where we have increased our footprint in the last 2 to 3 years. Rigorous monitoring at the highest level of administration and bureaucracy is leading to better implementation of the project. Leverage remains comfortable and gives leeway to participate in available growth opportunities. Now let me come to details of our company. But before I get into the details of financials, I would like to share a few important highlights for the quarter. As a part of its asset monetization plan, the company has sold 41% stake in one of its subsidiary companies, Michigan Engineer Private Limited, for a consideration of Rs 70 crore. This has enabled company to de-risk itself from the corporate guarantee of around 175 crore. The company still holds a strategic stake of 10% in the company for any future upside. Further, in this quarter, the company, based on consistent improvement in its performance over the last few quarters, reduction of debt and a healthy financial position, we have received an upgrade in its rating to BBB+. On the operational front, at our PAR project, which is located in Jammu and Kashmir, the company achieved a breakthrough at diversion tunnel having a total length of 698 meters. Also at Arun-3 project, which is located in Nepal, the company achieved a breakthrough at HRT having a length of 35313 meters. More importantly, in this quarter, the company received a letter of award for 3 irrigation projects and received for Sidco water tunnel project, which is in Maharashtra. The total value of this project is around 1320 crore. With this, let me now take you through the order book of the company. The current order book of the company stands at around 20,000 crore. This includes L1 around 1,800 crore. Coming to the composition and breakup of the order book, 61% of order book from hydro sector, 21% from irrigation, 12% tunneling, and 4% of our order book in the road and other segments. Also, around 54% of our order book is from central government, which is AA, AAA rated. Around 42% is from state government and balance 4% in Nepal. Now, I will go through the financial performance for Q1 FY24. Q1 FY24 was a quarter of healthy performance for the company. On a consolidated basis, revenue from operation for Q1 FY24 is rupees 118.6 crore, which is up by 24% from rupees 901 crore in the corresponding quarter in the previous year. This is on account of strong order book growth and well execution of projects across all sides. Previous period numbers have been restated based on the impact of discontinued operation due to disinvestment in our subsidiary Michigan Engineer. On a standalone basis, revenue from operation for Q1 FY24 is at rupees 1090.7 crore, which is up by 23.79% from rupees 881.09 crore in Q1 FY23. Operating EBITDA on a consolidated basis for Q1 FY24 is at rupees 170.56 crore, a margin of 15.25%, and net profit is at rupees 38.28 crore, which is up by 22.5% from rupees 31.25 crore in the corresponding period in previous year. However, profit from continuing operation for the quarter is at rupees 55.37 crore, which is up by 71.87% from 32.2 crore in Q1 FY23. On a standalone basis, operating EBITDA for Q1 FY24 is at rupees 152.2 crore, a margin of 13.95%, and net profit is at rupees 130.76 crore, which is up by 273.39% as compared to a profit of rupees 35.02 crore in Q1 FY23. Coming to sector-wise revenue breakup, on a standalone basis, hydro contributed 55%, irrigation 19%, tunnel 14%, road 6%, and other 6%. Moving on the debt position, the consolidated debt as on 30th June 2023 stands at 1955.67 crore. The consolidated debt to equity ratio is increased from 0.62 crores as on 31st March 23 to 0.67 as on 30th June 23. Although the debt seems increased from March quarter, the same is on account of replacement of high-cost client advance on one of our projects of 252 crores with a borrowing from financial institution, which gives us a saving in interest cost of approximately 4% per annum. The client advances on March 31 was rupees 1236 crore, which has now reduced to 955 crore as on 30th June 23. Hence, on overall basis, the advances plus debt has reduced from 2988 crore to rupees 2910 crore in Q1 FY24. Now coming to the breakup of the debt, working capital debt is around 114.29 crore and balance is term loan, which is expected to be repaid over next 2 to 3 years. The finance cost for Q1 FY24 on a consolidated basis is rupees 88.42 crore, which has reduced as compared to Q1 FY23, where finance cost was rupees 99.23 crore. On a consolidated basis, our diluted EPS from continuing operation has improved from 0.56 as on 30th June to 0.60 as on 30th June 2023, and debt divided by annualized operating EBITDA has improved from 4.2 to 2.87 year-on-year basis. Speaking about the arbitration claims, the government has launched various schemes for realization of arbitration awards under the NITI Aayog guideline and also has recently announced Vivad Se Vishwas 2 scheme for settlement of pending disputes related to government contracts. We are exploring our options under Vivad Se Vishwas 2 scheme, and with this scheme in place, we expect some claims to be realized in shorter period of time than earlier anticipated. Both these schemes will help deleverage the balance sheet, and realization of funds would help the company to augment working capital requirement and reduce debt. With the focus of the government on infrastructure development, we are positive and expect steady growth in our revenue and order book. That was a small brief from our side, and now I will like Vasupal to take over, and our team here shall be happy to answer any further questions which you all may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1 on your touchtone telephone. The first question is from the line of Yashwanti Ketkar from Cogent Finvest. Please go ahead.
Good evening, ma'am. I just wanted to ask, you have performed very well in the first quarter. What is the outlook for the rest of the year?
Okay, thank you, ma'am. As earlier we had given a guideline of a growth of around 15 to 20%, we would like to maintain the same.
Okay. And as you mentioned, there is a huge opportunity in the hydropower. Where do we stand as a EPC player?
So we are fully geared up to take the advantage of the situation. We are ready. We have strong pre-qualification. We have resources, and so we are ready to take the advantage of the opportunity available.
Are we in a current bidding process for any of the projects? Is it a right time or a right place to disclose about it?
So we have identified certain projects which we are planning to bid. So we see the around 1 lakh crore opportunities available. So we are targeting a few selected projects.
Ma'am, you just mentioned about the 3 irrigation projects. What is the quantum of it?
So total irrigation project, we received around 1,300 crores.
Right. So this was all what was L1 as of March that has been converted to LOA in this quarter.
Okay. And how much of the arbitration award we have received in current the quarter passed by?
In this quarter, we have not received any arbitration award.
Okay. Thank you so much. I'll come back in a few.
Thank you, ma'am.
Thank you very much. The next question is from the line of Tejas Shah from Laser Securities. Please go ahead.
Hi. About the arbitration awards and the land monetization, I think what we have shown is around 5,000 crores, I think 3,000 crores we are expecting or more?
Sorry, we didn't get your question. What is your question?
You mentioned, I think, in your investment slide, we are expecting some 4,000 crore of total arbitration and 1,000 crore of the total land parcel which is available to you as a non-core assets. Now, out of which you have shown a breakup in where you are already on the, realization, or it is in the final stages of awards around 1,200 crore odd. So when are we expecting that arbitration funds, and what is the timeline of disposing of the non-core assets and land parcels that we have?
So it will happen over a period of time. It will take 3-4 years to realize the arbitration awards and the land parcels. Again, there are few land parcels we'll sell and a few land parcels we'll hold for future upside. But yes, this year we are expecting around debt reduction of 200 crores.
Debt reduction of only 200 crores.
Yeah.
Okay. And what is the pipeline looking for in this quarter, for the current quarter, for the order winning?
So we have identified certain projects which we are going to bid. Last year we got the project worth rupees 7,700 crore. This year also we are targeting around 5,000 to 10,000 crore new orders adding to our order book. But it is a timeline like whenever the bidding bulk comes. So most likely we expect to get the projects in Q3 and Q4.
Q3 and Q4. But the elections will not hinder?
Yeah, there might be possibility. See, right now our order book is 20,000 crore. Book to bill ratio, it is 4 to 5 times. So we have sufficient orders in our hand, and we have identified certain projects which are going to come for bidding in Q3. So most probably we should be able to achieve our target, like 5 to 8,000 crore, which we are targeting this year.
Okay. Thank you.
Thank you. Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Shubham Sharma from PCR Capital. Please go ahead. Shubham Sharma, you may go ahead with the question. Shubham Sharma, if you can hear us, please go ahead with the question. There seems to be no response from the line of Mr. Shubham Sharma. We move to the next question. The next question is from the line of Viraj Mahadevia, who is an individual investor. Please go ahead.
Congratulations on stable results. 2 questions. One is with regard to, given your order book has moved up meaningfully, are we likely to see a step up in execution in the quarters ahead? Because I think given the order book, the Q1 results were not probably what one would have expected.
So we had given the guidance. See, our order book is mainly 61% is coming from hydro sector and around 21% is coming from irrigation. If you see hydro sector, it is a tenure, on an average tenure is 5 years. So we say that 20,000 crore is book to bill ratio is 4 to 5 times. So then considering that last year we had, for this year we had given the guidance of 15 to 20%. And we are in line of our projection. Like currently the growth is around 24%.
So maybe the growth is a little low in Q1, but it picks up in the back end of the year. So we look forward to seeing that. Second question is regarding the asset or non-core asset monetizations. Has there been any progress? Because we talk about this land bank. Have we put them up for sale? Have we put up our Tamil Nadu land bank on MSTC portal for sale? I mean, Electronic City is readily realizable. Why are we not selling that? 200 crores seems a pretty small target for the financial year FY24 in terms of non-core asset realizations.
Sir, so as I said that, we are not looking at selling all the land parcels together. There are some land parcels we would like to hold for future upside. Then again, we are in talks for some of the land parcels, but eventually it takes time, and that's why we have given a target of 200 crores this year. So we would like to be conservative in our targets.
Okay, sure. All the very best.
Thank you, sir.
Thank you. The next question is from the line of Yashwanti Ketkar from Cogent Finvest. Please go ahead.
Thank you once again for the opportunity. I just wanted to understand what is the rate you expect going forward with having such a huge order book in hand.
You are talking about revenue growth?
No, freight for the business or the execution risk.
Execution risk. So, see, we are doing business with government and we have a monthly billing. So, and obviously during monsoon, it is little seasonal, so it goes down and then picks up in Q3, Q4. Apart from that, we don't see any risk.
Okay. So, with the increasing order size, how much workforce count you have increased in the current year?
See, last year only we had increased. The last 2-3 years post-COVID, we increased our workforce from around 1,500 to 4,500. So we are all geared up to execute this.
So we have strong order book and we have started reporting good numbers. Are you planning to reward shareholders?
So, ma'am, see, we had done a debt restructuring few years back, so we are still some restrictions with the lenders. So maybe after a couple of years we can look at that in terms of dividends, if you are asking.
Thank you for my side.
Thank you.
Thank you. The next question is from the line of Arushi Shah from Sushil Finance. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Yeah. Hi, thank you for the opportunity. I have two questions. Firstly, the arbitration awards which have been awarded actually in our favor, where does it exactly appear in the balance sheet? Does it fit in any of our asset sides now?
So all the arbitration awards are not there. There are few arbitration awards which are reflecting in receivables or in inventory, but majority of them are still not on books.
Okay. And would you be able to give a percentage of what would be sitting in the balance sheet?
Say almost 50-50.
50%. Okay. And going further, also this number would prevail?
Sorry, your voice broke in between.
Yeah, so going further also this number would prevail, we would have a 50% arbitration in our balance sheet, which we consider more than in our favor in terms of probability.
So it depends upon, not in terms of accounting policy. So there are some awards which are in JVs and all, which are not there on books.
Okay.
That is why. So it cannot be maintained as the same ratio.
Okay. And so one few more questions I could squeeze in. So we generally do all the orders for the central government, state government. So why do we have so many claims pending? So what kind, if you could give some idea,
So in the past, due to change orders, delay in handing over of the projects, idle machinery and all, idle time.
Okay.
So these claims are built up, and that is why it is there. But it is all, we expect that, the claims are recoverable through arbitration.
Okay. And so just one small question. Our other expenses saw a drop, about 10 plus crores. Is it maintainable, or do we have some special situation where we saw a drop in our other expenses?
Sorry, actually your voice again broke in between.
Yeah, so our other expenses from the Q4 FY23 to Q1 FY24 dropped approximately 12 crores. So is that a maintainable other expense, or do we have a specific situation because of which we've seen this drop?
So it's actually, we talk generally about the maintenance of the margins. So we maintain EBITDA margins of 14 to 14, 15%. And the expenses and all will depend upon the type of work done in that quarter.
Okay. So there is no special situation where we've seen some major savings or anything?
No.
Okay, fine. Thank you so much, sir. Thank you. Best of luck.
Thank you. The next question is on the line of Hiren Ved from Alchemy Capital. Please go ahead.
Yeah, hi. I just have two questions. One is that our margins have been in the range of 13.5-14%. Is there scope to improve the margins from here on to, let's say, around 15-16%? That's my first question. The second is, we hear that there is a large opportunity in the pumped hydro sector. Are we participating there?
So in terms of EBITDA margins, it will actually little depend upon the mix of the work executed in the quarter. Right now, based on the order book mix we have around 60% hydro, we expect the margins to be in similar range unless in a particular quarter some additional execution is there. Yeah. And
as regards pump hydro, yes, we are looking for that opportunity. In past also we have done Geiger pump storage project. Currently we are executing Kunda project. So we are looking out that opportunity.
And is that already a part of your hydro order book, or you think that that's over and above the normal hydro projects, there could be a bigger opportunity in pumped hydro?
Yeah, over and above this normal, we see the big opportunity available in pump storage hydro.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Kishan Toshniwal from Pola Ventures. Please go ahead.
Yeah, I have two questions to the management. One is, how much debt we are sitting on right now in the books as on 30th of June?
1,955 crores.
As a consolidated.
At a consolidated level. And do we intend to reduce this debt only by monetizing through the non-core assets, or are we planning to pay this off through our cash that we generate during the quarters as well, through our cash flows also? Or are we only going to pay off this debt as and when we get the monetization of assets, non-core assets?
No, it is a mix. Partly paid through operations and partly through monetization. We prepay and we expedite early payment through monetization, and the rest we pay from operations. We expect to pay from operations.
And continuing on the last participant, he said that he asked about the EBITDA margin that you are talking about, which people are saying that it will be stable in the range of 14 to 15%, right? Right. So I'm not looking at from next 2-3 quarters, but 2-3 years down the line, when we see this company retiring with debt completely, getting debt free and all, what is the kind of EBITDA margin that we can expect in the future, maybe 2 years down the line? Maybe that period is too long, maybe 1 year or 2 years down the line. What is the expectation that the management has, or what operating levels can kick in and take this EBITDA margin to the level, if you can explain?
See, currently the kind of projects we are having in order book, our expectation is 14 to 15%. And with reduction of debt, interest is going to reduce, and we expect to improve our net profit margin. But as regards...
What would be that?
Right now it is around 4 to 5%, and we expect to increase eventually. It is 8-10%.
Okay. And my final question is, the non-core assets that we are sitting on. You just mentioned that you are waiting for the right time to exit from those non-core assets. That means, are you saying that you are going to get a better price in the future, or you are saying something that we are not right now able to see, because the Electronic City and the Panvel project land that you are showing, 15 acres and 11 acres, those are very easy to get rid of if you want to sell it. But are you seeing a growth there or a price rise in the non-core assets that you are having, because of which you are waiting?
Yes, in few land parcels we may see that in future.
Yeah.
Okay. Because of that you are waiting, right?
Right.
Yeah. Some of the land parcel, yes.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you. And congratulations on good set of results and good work on reviving the company. My question is, most of our EBITDA is actually going in interest payment. So while optically 15% looks a good margin, the interest cost, and especially if we include bank guarantee charges, which is an integral part of doing the business, then the actual surplus available to us is very small. So, what that would mean is that generating operating cash flow, especially if growth is going to be there and we need working capital for growth, is going to be difficult. So how do you look at it? And, is this understanding of mine right, or you think it should be looked at it in some different way?
Thank you, sir. See, if you see current quarter, we have started, there is a reduction in interest cost, because last year we reduced the debt by 500 crores. This year also we have a plan to reduce by 200 crores. And eventually next 3 years, if you see, we have a plan of reduction of debt of around 500 to 700 crores. So eventually that is going to come down, and my net profit margin we expect to increase.
No, I agree with you, but debt reduction is happening through sale of non-core assets, right? Actually, operating cash flow generation, if we take working capital requirement for growth into account, I think it's going to be very small sum, marginal sums. So that's what I'm trying to understand.
So, sir, the way we work is we take client advances and we fund our mobilization and all from client advances. Some portion is funded from our surplus we generate. So that is how our model is. And we don't see a challenge in getting new orders and execution and growth in thereon.
Yeah, I am at a different point. From stock market point of view, we look at free cash flows. And even if you take client advances, you're paying interest on it, right? You're paying interest on mobilization advances. So how does the company generate free cash flow and therefore create value for shareholders? That is what I'm trying to understand. Ultimately, market will start asking this question, and therefore 14% EBITDA margin, while it may look good, probably needs to go to 17-18%.
So, sir, it will happen on multiple grounds. So, one is we are obviously looking at cost control measures and improving our margins always. And the other is reduction of debt. Then now reduction of debt, that is why we focus on non-core asset monetization also. As and when money gets realized, we can reduce the debt. And the surplus from the business can be put in the as working capital for existing projects or new projects, and we don't increase debt for that purposes.
Okay. Thank you.
Thank you. The next question is from the line of Ashka Trivedi from Kedia Securities Private Limited. Please go ahead.
Hello, sir. Am I audible?
Yes, sir.
Ma'am, my question is that we have a current order book of about 20,000 crore, and as you said that our book-to-bill ratio is 3 to 4 or 4 to 5 times from here. And in the last financial year, we posted a top line of 3,800 crores. So I just wanted your guidance that 4 to 5 years from now, how much percentage of 20,000 crore are we expecting to translate in the form of top line?
So we expect growth next 2 years is around 15 to 20% in revenue for next 2 years.
And ma'am, a long-term point of view, like 4 to 5 years from now, what top line are you envisioning out of this 20,000 crore?
Out of this 20,000 crore, we expect our order book to continue grow at around by 10%. So we expect in next 2 to 3 years our order book to take to around 25,000 crore and our turnover to around 4,000 crores. 5,000 crores.
Okay. And any broad guidance like 5 years top line guidance?
So we are looking at actually not on that same sense, but if our order book keeps on growing as we are, so we can see a CAGR growth of 15-20% year on year.
Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Pratap Makwana from Forbes Marshall Private Limited. Please go ahead.
Good afternoon and congratulations for the excellent result to the Patel Engineering team. My question is actually from the 20,000 crore total order book, how much we are expecting to realize in the form of the order closure in money received in the form of Q3 and Q4, and continue to on that, how much is the recovery? Because majority order from the government agency. So how much is the recovery we are expecting in this Q2, and whether we are expecting on any LD on this recovery or any quality acceptance level on the penalty side?
So there is no issue about quality or penalty or anything. We have a monthly billing to the clients, and there is no risk of recovery getting stuck. So all projects, whatever we are billing, we are having a net working capital cycle of around 3 to 4 months, but then we get that generated churning is happening. And as we have already said that this year we are expecting a revenue growth of 15 to 20%.
Okay. So can you throw some light on the quarter-wise revenue actually, Q3, Q4, and as this is August month going on, July also has been executed things, and few of the order are under the closure also in this month also, next month also. So if you can provide some approximate value breakup, that will give us the idea. And whether any LD is affecting on that you have already covered that no LD. So can you give some breakup on this, sir?
Sir, so it is difficult to give a quarter-wise breakup like that. It will depend upon what sort of work is executed in the quarter. But generally with our past trend, so based on, because we are in construction business, monsoon is little lower compared to the other 3 quarters, and then Q3 and Q4 are the best quarters of the year.
Okay, right. But any because from the 20,000 crore order book, any re-looking on the orders or re-validation of the order, or again maybe there is a chance of again establishing the order value on the higher side due to the time period, whether the execution some 2 years, 3 years execution down the line from the 20,000 crore?
No, it is all under execution. There is no such risk.
Okay. So all of them we can say that by after Q4 and maybe next 1 year, these orders are under the all of them will be under the recovery in the next one or 1.5 year of time. Correct, sir?
Sir, our order book is 20,000 crores, which is to be on an average period is 4 to 5 years. So it will be executed in 4 to 5 years.
Yeah, 4 to 5 years is a longer time in terms of we can say from the recovery and the closure point of view. That is the reason I emphasize that people can give some idea.
No, sir, original period, because 60% order book is coming from hydro sector, where the original tenure is 4 to 5 years.
Yes. Okay. But sir,
recovery is, sir, whenever we execute, we bill monthly to the client and we get recovered that payment month on month. Okay. So there is no such issues of recovery.
Yeah. So I'm coming from that because you are emphasizing on 20%, but there may be chance that the the growth can be higher also because of once the monsoon is over. Correct, sir?
Correct. Once the monsoon over, it can be higher. On a conservative side, we are giving guidance of 15 to 20%.
Great. Thank you. That covers my answer. Thank you.
Thank you. The next question is from the line of Ananya Swaminathan from P Square. Please go ahead.
Hello, am I audible?
Yes, ma'am.
First of all, congratulations with the numbers.
Thank you, ma'am.
Yes. So I just wanted to know that we have strong order book giving revenue visibility for next 3 to 5 years. So when the shareholders will be rewarded?
So, ma'am, right now we cannot declare dividends. Maybe after a couple of years. Till then, we will deploy the money in the business itself. And then after that, once our debt position is also reduced, we will start looking at something.
Okay, all right. With increasing order size, how much workforce count has increased?
So we have increased our workforce almost 3 times in post-COVID, when our workforce was around 1,500. Today we are at around 4,600.
All right. And do the company benefit from any government incentives or any grants?
No, nothing as such.
Okay. All right, sir. That's it from us, sir.
Thank you.
Thank you. Next question is from the line of Aman Kawad from Aman Investments. Please go ahead.
Yes, ma'am. I think I'm audible. Ma'am, first of all, congratulations on achieving the top line numbers. Ma'am, just a follow-up from the previous question which came, just to get a brief idea, like the 20,000 crore order book majorly comes from the infrastructure hydro projects. So these projects, what is the vision of our Patel, as in 4 to 5 years, and 4,000 crores you mentioned, it's per annum, right?
You're talking about revenue?
Yeah, revenue, sir.
Yeah, revenue.
Revenue. And the 5,000 crore vision is from which year we can expect that to happen?
In next 2 years, we expect to, we are expecting 15 to 20% CAGR year-on-year basis. If we count that, if today, last year it was 4,000, after 2 years we expect to reach to 5,000 crores.
Yeah. Ma'am, and the major order book comes from recently launched Jammu Kashmir. So when are we seeing it to realize completely? When is those projects are going